Well, that's a good question. I mean, after the kind of guidance that Yellen gave in the post press conference, there would be a lot of attention being paid to what is being said about what the interest rate landscape is going to look like. Our view is twofold. First is we don't think there's going to be concrete guidance on exactly when the rates will be raised. So there's not going to be much to go on. And besides, the fact that Yellen has very much softened her stance and made it more tentative ever since the FOMC meeting means that these backward-looking minutes will be weighing on markets' minds less. So initially there may be a knee-jerk reaction, but we don't think they'll mull on it too long. Well, I think what we are generally seeing is that the fact that US Treasury yields have come down in the last 2 weeks or so means that money is going out to look for yields. So yes, selectively some EM asset markets have benefited from this. In India's case, it's very specific. I think it's a bet on BJP victory and that Modi will bring on board a lot of reforms. So the bet here is that equities will benefit from the opening up and the cutting of the red tape and investments coming in. This is actually to some extent quite durable, but we also warn that just heading into the elections there may be some moderation in the equity market rally for markets to wait and watch how the coalition formation would be in India. So we are going to take a bit of a cautious approach as we head into the elections, but post-elections a strong coalition means this rally could probably go on a bit further. To some extent, I think the World Bank is just reflecting the underlying, structural reforms that are ongoing in China and the fact that the rest of Asia is also not seeing strong exports gains. To some extent, this just reflects the current challenges that Asia faces as a whole. But we also take some consolation in the fact that China is going to unleash a bit of a mini stimulus, so which means that China's growth, rather than running a high risk of slipping towards 7%, could be buoyed above 7.5% quite easily. Sure, we're not going back to the heydays of double-digit growth, but equally that means that we need not get alarmed about the growth prospects. Rather, it's just embracing the reality that Asia as a whole will continue to see gradual recovery but remain in sub-trend growth nevertheless. Well, we think today's BOJ meeting was pretty much spectator sport, really because the BOJ is watching how things develop. While the BOJ, I think, is saying that the outlook is quite bright and it's improved at least, that does not rule out the possibility, or in fact the high probability of another round of stimulus coming through, because we think that a lot of the consumption was brought forward ahead of the sales tax. So when that begins to weaken, and the fact that I think corporates are not investing enough, so capex is still quite low, I think that would actually mean that the BOJ would be inclined to do more, not less, and that should translate into yen getting into the 105, 110 range for the dollar yen into the end of this year. So that's what we're looking at. We're looking at BOJ, allowing and acknowledging some improvement in the economy, but that doesn't mean it's dropped the baton on stimulating the economy further.